One evening I sat my son down and said, "You know, everyone's complaining that home prices are too high. But when you're older, I'm going to sell you this house for just $1. I expected excitement. Instead, he shook his head. "No, don't do that." I raised an eyebrow. "What? You don't want the house?" "Of course I do, but don't sell it to me for $1. Now I was really confused. "Why not? By the time you're old enough, it'll be worth over $500,000. That's instant equity." He sighed. "Dad, it's not about the $1. Then what's the problem?" He leaned in. "The problem is that if I sell in the future, I'll have to pay taxes on the $500,000 of equity you're gifting me. And that's not all. We'd also have to file a 709 form with the IRS to declare the gift." I sat back, impressed. "All right, smart guy. What should we do instead? Put the home in a trust and name me as the beneficiary." Now I was really curious. "And why would we do that?" He grinned. "Because when you pass away, the house will automatically transfer to me, with a step-up in basis." I nodded slowly. "Step-up in basis?" "Yep. That means that if I sell it, I only have to pay taxes on the gains that happened after I inherited it, not the entire value of the home." I did the math in my head. "So instead of paying taxes on $500,000, he finished my sentence, "we save at least $150,000, keeping more money in the family instead of handing it over to the IRS. I shook my head, laughing. "Wow, you're pretty smart, kid. Did they teach you that in school?" He smirked. "Nope. I learned it on my own." And that, my friends, is the kind of education that actually builds wealth. Now let's unpack the key lessons from this conversation, because this goes far beyond just real estate. It's about adopting the mindset of the wealthy and recognizing how financial literacy can be the difference between building lasting generational wealth or unknowingly losing it to avoidable mistakes. Understanding tax implications. Most people don't realize that selling an asset for just $1 can trigger significant tax liabilities in the future. Without proper planning, what seems like a generous gesture can result in hefty capital gains taxes, gift tax complications, and unnecessary financial burdens. By understanding tax-efficient strategies, such as trusts, step-up in basis, and wealth transfer planning, families can legally minimize tax exposure, preserve more of their assets, and build generational wealth that lasts. Generational wealth planning. Most families focus on making money but don't plan for how to preserve and transfer it across generations. The truly wealthy don't just accumulate assets. They strategically structure their wealth to minimize tax burdens, protect their legacy, and ensure financial security for their heirs. Through smart planning tools like trusts, step-up in basis provisions, and legally optimized estate strategies, they prevent unnecessary losses to taxation and probate. Without these measures, a lifetime of hard work can be significantly diminished by avoidable financial pitfalls. Teaching these principles early empowers future generations to build on a strong financial foundation instead of starting from scratch. The power of trusts and estate planning. A well-structured trust does more than just transfer wealth. It safeguards assets from unnecessary legal fees, creditor claims, and delays caused by probate. While commonly used by high-net-worth families, this strategy is accessible to anyone looking to preserve generational wealth, maintain privacy, and ensure their financial legacy is passed down efficiently. Thinking like an investor, not just an earner. My son didn't just focus on acquiring the house. He looked beyond ownership and considered the long-term financial impact if he ever needed to sell. That's the mindset of a true investor. Not just building wealth, but strategically minimizing losses and maximizing how much stays in your pocket. He understood that wealth isn't just about what you earn, it's about what you can keep, grow, and pass on efficiently. By thinking ahead and applying tax-smart strategies, he demonstrated the kind of financial awareness that separates those who struggle from those who thrive across generations. The power of self-education. Schools don't teach this. Traditional education emphasizes earning a paycheck, but true financial freedom comes from mastering wealth-building strategies. While most people are taught to work for money, the financially savvy learn how to make money work for them. By exposing kids to concepts like taxes, investing, and asset protection early, We equip them with the knowledge to make informed decisions, avoid costly mistakes, and build generational wealth. Encouraging independent financial learning doesn't just give them an advantage, it gives them the power to create a future where they control their financial destiny. Delayed gratification and long-term thinking. A short-term mindset would have been, yes, sell me the house for $1, taking the quick win without considering the consequences. But long-term thinkers don't just focus on what's easy today, they play the game strategically, ensuring every financial move benefits them in the future. By understanding tax laws and structuring decisions wisely, they can avoid costly mistakes and maximize their wealth over time. This is the difference between simply acquiring assets and building lasting financial security. Step up in basis, a hidden wealth-saving tool. The step up in basis isn't just limited to real estate. It applies to stocks, rental properties, businesses, and other appreciating assets. This powerful tax advantage allows heirs to reset the asset's value to its fair market price at the time of inheritance, significantly reducing or even eliminating capital gains taxes when they sell. Understanding this single rule can be the difference between preserving generational wealth and losing a significant portion of it to unnecessary taxation. You can simplify the concept with an easy-to-understand analogy using stocks. Imagine Grandpa bought Apple stock decades ago for $10,000. By the time he passes away, it has grown to $100,000. Normally, if you sold it, you'd be taxed on the $90,000 gain. But with a step-up in basis, the stock's value resets to its current market price at inheritance, meaning your new cost basis is $100,000. If you sell it immediately, you owe zero in capital gains taxes. This strategy isn't just for stocks. It applies to real estate, businesses, and other appreciating assets, helping families legally avoid massive tax burdens. Why selling for $1 is actually a costly mistake. Many well-meaning parents assume selling a home to their child for $1 is a generous act, but in reality, it triggers major tax consequences, turning what should have been a gift into an expensive financial mistake. Instead of preserving wealth, this decision can lead to unnecessary gift tax filings and massive capital gains taxes when the child eventually sells the home. For example, imagine a father who bought a home for $100,000 decades ago, and by the time he sells it to his daughter for $1, it's worth $500,000. Because she technically bought it, she inherits his original cost basis of $100,000. If she sells it later at market value, she faces capital gains taxes on a $400,000 profit, potentially costing her over $100,000 in taxes. Had the home been passed down through a properly structured estate plan, she could have received a step-up in basis, avoiding that tax bill entirely. This is why financial literacy is crucial. Understanding the right strategies can mean the difference between preserving wealth and losing a significant portion to unnecessary taxes. Understanding different types of trusts and their benefits. When it comes to estate planning, trusts are one of the most powerful tools for preserving and passing down wealth efficiently. But not all trusts work the same way. Here's how different types of trusts function and why they matter. Revocable trusts maintain control over your assets. A revocable trust, also known as a living trust, allows the grantor, the person creating the trust, to retain full control over their assets while they are alive. They can modify, add or remove assets, change beneficiaries, or even dissolve the trust if needed. The primary benefit of a revocable trust is avoiding probate. When the grantor passes away, the assets transfer smoothly to beneficiaries without the delays, legal fees, and public scrutiny that come with the probate process. However, because the grantor maintains control, the assets in a revocable trust are still considered part of their estate for tax purposes, meaning they don't provide protection from estate taxes or creditors. Irrevocable trusts, stronger asset protection and tax benefits. An irrevocable trust, on the other hand, cannot be easily changed or revoked once established. When assets are placed in an irrevocable trust, they are no longer considered part of the grantor's estate, which provides two major benefits. 1. Protection from estate taxes. Since the assets technically belong to the trust and not the individual, they are not counted toward the estate's total taxable value, potentially reducing or eliminating estate taxes. 2. Shielding from creditors and lawsuits. Because the assets are no longer in the grantor's direct control, they are generally protected from creditors, lawsuits, or financial liabilities. While an irrevocable trust provides stronger protections, it requires careful planning. Once assets are transferred, the grantor loses direct access and control over them. How trusts help avoid probate. One of the biggest advantages of using a trust is avoiding probate, the legal process of distributing a deceased person's assets. Probate can take months or even years to finalize, cost thousands of dollars in legal fees, and make financial matters public record, removing family privacy. When assets are held in a properly structured trust, they pass directly to the named beneficiaries without court intervention. This ensures a faster, smoother, and more private transfer of wealth. A well-planned trust isn't just for the ultra-wealthy. It's a strategic financial tool that anyone can use to protect assets, minimize taxes, and ensure their loved ones receive their inheritance without unnecessary delays or legal complications. Whether you want to maintain control with a revocable trust or maximize protection with an irrevocable trust, the key is planning ahead to secure your family's financial future. Parents can effectively teach financial literacy by making lessons interactive with "What would you do?" scenarios, using real-world examples of how wealthy families structure their wealth, encouraging kids to research tax-saving strategies, and introducing them to financial planning books and courses. Additionally, they can involve their children in real financial decisions, such as discussing investment options, explaining tax implications, and even role-playing negotiations or estate planning scenarios to develop critical thinking and an investor's mindset from an early age. Now, I know you probably have a lot of questions running through your head right now. Does this apply to all assets? What if the home still has a mortgage? Can anyone set up a trust, or is it just for the wealthy? These are great questions because when it comes to money, the details matter. The more you understand, the more you can use these strategies to your advantage. So let's dive into some of the most frequently asked questions and clear up any confusion so you can start applying these lessons in your own life. What if my child doesn't want to keep the house? No problem. A trust provides flexibility, allowing them to sell the property while minimizing tax burdens. By utilizing a step-up in basis, they can significantly reduce or even eliminate capital gains taxes, ensuring they receive the full value of the asset. Plus, a properly structured trust can protect the proceeds from creditors, lawsuits, or financial mismanagement, giving them both freedom and security in handling their inheritance. Does this work for rental properties too? Yes. The same step-up in basis rule applies to investment properties, meaning your heirs would only owe taxes on the appreciation that occurs after they inherit the property. This can result in massive tax savings, potentially millions, especially for long-held rental properties in high-growth areas. Plus, if the property continues generating rental income, they can benefit from ongoing cash flow while still avoiding a large tax burden. What if the house is still under a mortgage? The mortgage doesn't disappear, but ownership transfers with the same tax advantages. The beneficiary will inherit both the property and the remaining loan balance, but they can continue making payments, refinance, or sell the home without triggering unnecessary tax burdens. In a trust, the mortgage can be managed efficiently, ensuring a smooth transition while still benefiting from the step-up in basis and avoiding probate delays. Can this strategy apply to businesses too? Absolutely. Business assets can also be placed in a trust for tax-efficient inheritance, protecting them from probate and unnecessary taxes. This strategy ensures a seamless transfer of ownership, minimizes estate tax burdens, and helps maintain business continuity. Whether it's a family-owned company, rental properties, or stock in a corporation, structuring these assets properly can preserve generational wealth and prevent forced sales due to tax liabilities. What happens if tax laws change? Tax laws can and do change, which is why it's crucial to stay informed and work with a financial professional to adapt your strategy. While the step-up in basis rule has been debated in the past, proper estate planning, such as using trusts, gifting strategies, or life insurance, can help safeguard assets and minimize potential tax burdens regardless of legislative changes. Having a flexible plan ensures your wealth transfer strategy remains efficient no matter what happens in the future. Have you ever had a conversation like this with your kids? Or did your parents ever teach you about passing down wealth? If not, now is the perfect time to start. The way we transfer assets can shape our family's future for generations. Share your experiences in the comments, whether it's a lesson you've taught, a mistake you've learned from, or a strategy that worked for you. Let's inspire each other to build lasting wealth the smart way. Financial knowledge like this isn't reserved for the wealthy. It's for anyone who wants to break the cycle and create lasting generational wealth. If this insight was valuable to you, don't keep it to yourself. Hit like, subscribe, and share it with someone who needs to hear it. Together we can help more families take charge of their future and truly live the dream.